Vega measures the sensitivity of an option's price to changes in the implied volatility of the underlying asset. In simpler terms, Vega quantifies how much an option's value is expected to change for every 1% change in implied volatility. Implied volatility measures the market's expectation of the future volatility of the underlying asset over the lifetime of the option contract. Unlike historical volatility, which measures past price fluctuations, implied volatility is forward-looking and is derived from option prices. The price of an option is not only impacted by changes in the underlying asset's price and time to expiration, but also by changes in market volatility. During volatile market conditions, options tend to become more expensive. Events such as earnings announcements often result in large moves in the underlying stock. As a result, options that include an earnings announcement within the lifetime of the contract typically have higher implied volatility. After the earnings announcement, implied volatility tends to decline rapidly. This means that even if the underlying stock does not move after the earnings release, the option is still expected to decline in value due to an implied volatility crush. Vega generally peaks for at-the-money options and decreases as the option approaches expiration. In other words, the more time remaining until expiration, the more sensitive an option's price will be to changes in implied volatility, particularly for at-the-money options. So how can Vega be used in options trading? First, it's important to remember that long calls and puts have positive Vega, where short calls and puts have negative Vega. A strategy with net positive Vega will benefit from an increase in implied volatility if market conditions become more volatile. Conversely, strategies with net negative Vega will be disadvantaged by an increase in implied volatility. If an investor expects a spike in volatility for an underlying asset, buying options or constructing a multi-leg strategy with positive net Vega may be beneficial. In this scenario, an increase in implied volatility would be expected to increase the value of the option. While this holds true in theory, historical market behavior shows that when volatility increases across the broader market, option prices often rise, while equity prices tend to decline. This dynamic can also affect the overall profitability of a strategy. Investors should keep this relationship in mind when trading based on volatility and Vega. In conclusion, understanding Vega is a key component of successful options trading. Incorporating strategies that align with volatility expectations can help investors navigate market fluctuations and potentially capitalize on opportunities. Visit bmo.com/onlineinvesting to get started.